Hey everybody, good to be here with you today. My name is Brent Moore. It's time for Advanced Option Strategies today. The topic actually I kind of want to cover today is something that is born out of, I was doing chat in another session the other day, and the question came in of, hey, should I do multiple contracts or should I do a wider spread? I want to talk about how spread width and strike selection can certainly affect your options trading. So that's our goal today here in our class. I'm glad you're here. I don't, whether you're watching recording or live, we're just glad to have you. And when I say we, I mean me and James Boyd's helping me out in the chat today. So I appreciate James. And so as you have questions between James and myself, we'll do our best to get those answered. And also you can follow us on X if you like, at Brent Moore CS, at James Boyd CS. And remember, options do carry a high level of risk and are not suitable for all investors. The information today I'm going to go through is for general informational purposes only. It's not a recommendation of any security strategy or chart type. Schwab does not recommend the use of technical analysis as a sole means of investment research, although we will be using technical analysis in this class. Paper money software application is for educational purposes only. For the sake of simplicity, a lot of the examples I use, I'm not going to talk about commissions, but I actually am going to talk about commissions a little bit today because that is a factor that that should go into your trading, that you should consider in your trading. So all investing involves risk, including loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. Stop loss orders. There's no guarantee of that execution of that stop loss order at or near the stop price. There we go. We'll look at individual stocks today, individual option trades, but those are not, they're not recommendations. This is the market right here, folks. Strong trend, our all-time high, 6,000, this is the SPX, 6,099.97. We hit that earlier today. I don't know where we're going to close. Will we close at another all-time high? I don't know. We'll see. We got a couple hours to go in the trading day. But let's do this. Let's look at some trades, some potential trades, because I want to make this as practical as possible. And just a reminder for those of you who are new, generally when we're doing technical analysis, which is what we tend to focus on in this class, we often will talk about trend and support and resistance as kind of the key things we're looking at in terms of technical analysis. So if we're looking at, for example, at American Express, I'm going to be looking for the trend to try and give me a clue for more of a bullish posture or bearish posture. Of course, things can change. In this case, we have an upward trend, and then we're going to look for maybe levels of potential support. And in this case, we actually had a stock that's been kind of flagging, up and the back and up and back. Is this a support level, right? Do we just get a little support bounce there? That pin is a little thicker than I intended it to be. Let's do this. Is this there? Is that a support bounce? Well, it looks like it may be. That's certainly a possibility for kind of maybe a bullish trade. In this case, the trend is the main consideration here, I would say, but there's maybe more neutral stocks that we're looking at where the stock's not retracing that much, but if we see a decent support or resistance, we may still do a trade on that. Obviously, for trend traders, typically you're going to use the trend, okay? The trend is a key level. Now, if I'm doing a trade, so I'm going to just let's pull up a different stock. We may come back to American Express, I don't know, but I want to start off, I'm going to look at Disney here. Okay, so here's Disney. Oops, there's Disney. And we had a strong move up on Disney and maybe losing some momentum here. And what I'm going to look at is a potential bullish trade, a short put vertical spread here in this case. So let's look at a short put vertical on Disney. And I'm actually going to do so on the Analyze tab. And I'm going to go out about a month. We'll go out 28 days here on Disney. And what I want to do is I'm going to look at this as a vertical spread, but I'm going to do this as a short put vertical, and I'm going to use delta as kind of a clue as to where I want to look for my strike price. So I'm going to go somewhere around a 30, 35, 40 maybe delta. I'll go right in the middle, 35 delta, 115 strike. Okay, now I want to make sure that corresponds to the chart. 115. Does this seem like a reasonable level on a chart here, this 115 level, as a potential support level? We're assuming the stock's going to stay above that. Of course, it may not, but I'm going to put a strike down here, and we'll buy a lower strike, and we want the stock to stay above where that red line is. Okay. Now, if you don't think it's going to, if you think, Disney is just used all its fuel and it's going to crash here, then you want to do the trade. But that's what the trade I'm going to look at right now. But the question is, what if I do a 115, 114, or maybe a 115, 113 strike? What are the differences there in that? Assuming we're bullish on this, what strike width should I use? How many contracts should I do? Instead of going 115, 113, what if I do 2 contracts of a 115, 114? Remember, if you are doing multiple contracts, let's think of it this way. When you're considering a trade, a spread trade, I don't care what kind of spread trade you're doing, I want you to consider, what is your max gain? Okay. What is your max loss? And with those two together, that's going to give us your return on risk, ROR. Those are important considerations there. And then one other thing I want to talk about is, an important factor is, what is your break-even point? How do these things get affected? And with break-even, in parentheses next to break-even, I'm going to put your probability, because your break-even determines your probability. I'm hoping that makes sense. If on this trade, if I have a bullish trade, and let's say my break-even were down here, there's a higher probability the stock's going to stay above that than if my break-even were up here. So the break-even determines the probability. That's what we want to consider. And that's a huge factor, because all in all, what I care about is return on risk, which we generate from max loss, max gain. What's your return on risk? What's your probability? Okay, profitability and probability. And generally, they kind of go inverse to one another, right? The higher the probability, the worse the profitability, and vice versa on that. So it's a trade-off, and it's not a right or wrong answer on that, but that's what we're going to consider. So let's look at that, 115 strike here. So let me get rid of that. I'm going to go to my Analyze tab. I'm going to go to my 115 strike. I'm going to put this in as a vertical. We'll do 115, 114, and click on that bid price there. And let me click on that again, because I want to compare 2 of these together here. And I'm going to do 115, 114, and 115, 113 here. Okay. Now, one choice I have on this is I could just up the number of contracts here. I have the 115, 114, $33 credit for one contract. If I up the number of contracts, how does that affect my max gain, my max loss, or my return on risk? Okay. How does it affect that? And how does it affect my break evens? The answer is, it doesn't really. Well, it affects my max gain. Like if I do 2 contracts, my max gain is going to go up double, okay? But my max loss is going to go double too, right? If I do 2 contracts. I'm not going to actually go and change that right here, because I think that's an easy enough concept. You guys got that. So therefore, my return on risk doesn't change. And my break even doesn't change either. What does change, though, would be commissions, okay? And that is a factor, but it's not as big a factor as it once was, right? Right now, I'm going to assume like a 65-cent per contract commission. In the grand scheme here, in terms of the overall trade, that's not for my purposes in this case, I'm not going to consider it that much. I don't want you to ignore commissions, but it's probably not going to be the overriding factor on these trades right now, is that 65-cent commission here. And keep in mind, when I say, 35-cent credit, we're multiplying that by our multiplier of 100 here. The commission, that's truly 65 cents for a contract. So if I make that 2 contract, well, look, I've got 2 legs on this. So it's $1.30 for this. And if I double that, then it's $2.60 a commission. Again, probably not the overriding factor there, but that's the difference by upping the number of contracts I have, is that commission. But let's look at some other factors here. If I'm doing this and I'm looking at this 115, 114, let's talk about this versus a 115, 113, widening it out and maybe making some generalizations from that as we do this. Because my max gain here on this, my max gain, if I do a 115, 114, is my initial credit. And these numbers may move around just a little bit on me as we're talking here. Max gain is 33. What's my max loss on this? Well, it's my width of my strike, so $1 minus my 30, I'm going to say 33, even though that's moved on me. That's max loss 67, okay? And my return on risk is going to be 33 divided by 67. Let's do that. 33 divided by 67. I just have a little calculator here. That's right around 50%. Okay, that's roughly 50%. So it's actually 49% is what that's coming up as. Okay, 49%. And where's my break even on this? Okay, my break even is my upper strike. So this is a short put vertical. My upper strike minus my credit puts my break even at 114.66, or if I keep my max gain at 33, 114.67. Break even, okay, 114.67. Okay. Now, let's contrast that here. I'll put a double line. Okay. Let's contrast that with my 2 wide strike here on this. Both, from a technical standpoint, they're pretty similar, right? So we're kind of getting into the nitty gritty of this here on this. But my max gain is, my max gain is 61. Okay. My max loss is $2, because we have a 115 minus 113 is $2 minus, did I say it wasn't 61, it's 64. How did I come up with 61? Okay, so again, it's moving around. I'm going to say 64. My max gain is 64. My max loss is 136. Did I do my math right there? Those two should add to $2. Yep, 136. Therefore, my return on risk, what's my return on risk? My return on risk is 64 divided by 136 is equal to about 47%, okay? So in this case, there's not a huge difference on that. Let me go to one more thing. I'm going to do break even here on this last one. Then we'll make our generalizations here on this. My break even is my upper strike minus my initial credit, which is upper strike is 115 minus 64 cents is going to be, we're testing my math here, folks, 114 minus 64 is 36. I think I did my math right there. Okay, now the generalizations here. All right, now generalizations. In general, when you're talking about a short put vertical or a short call vertical, same thing. In terms of this, your return on risk will go down if you widen the spread. If these are out of the money short verticals, the return on risk is less the wider the spread is. Okay? It's less the wider the spread is. Now, in this case, it's not really showing a huge difference. I will tell you, in my experience, though, typically it is a bigger difference than that. Typically, you're probably closer to 10% difference on your return on risk rather than that 2% that we did. But just remember, the wider your spread on an out of the money short vertical, the worse your return on risk will be, but the better your break even will be. In this case, it's better to have this break even to be lower than this one. That's better. So if you're deciding that, it comes back to the old story. It goes back to the old story of it's probability and profitability, and it's a balancing act between the two. Andy says in the chat, what if I went 5 strikes wide? Well, we can do that, but what you're going to see is a more extreme version of what we just did right here. I can tell you, we can look at it, but your return on risk is going to be worse if you go 5 strikes wide. Your break even will be lower. It'll be a little bit better because the max gain will be better on that. Okay, and that max gain will be bigger. Therefore, when we subtract that max gain from my upper strike, it's going to be lower. So probability, profitability, it's a balancing act. In this case, there's not that much difference in terms of the return on risk. As just at risk of belaboring it, normally I see a bigger difference in the return on risk there between those. And that's probably why normally I'm not doing very wide spreads in this class here. All right. So what I'm going to do is I'm going to place that trade here. And what I'm going to do is I'm actually going to do the wider spread here. That's going to give me the bigger credit. Now, remember, I have the choice. I can get more credit. This is roughly, kind of very roughly, double the credit here. I could double the number of contracts here, but remember, that's going to add more commissions as well. Okay? So let me go. I'm going to do, we're going to look at this one here, and I'm going to confirm and send that. And we'll look at that, and I will send that. Let me just double check chat. Sorry, I need to wake up you, so showing gain loss of each of the verticals. So here we go. This is you can, by the way, so if I went too fast on figuring out return on risk on these, by the way, you can always just confirm and send the order. And it's on the order confirmation dialog box, it gives you those numbers right there. Okay. I have when I'm using that annotation tool, I can't flip between screens, so I can't do that. So that's one reason I was kind of talking about it that way, but this is an easy way to do it there. Okay. So let's go and let's throw this order in, and I'm going to send that order, and we got filled on that. So now we have a trade on Disney. Now, so we have that Disney trade. Question, when do we exit? Well, here's when we exit. Number one, remember, short verticals, whether short call verticals, short put verticals, really a lot of the benefit comes from the time decay in those, and therefore we're going to be generally patient with them. If it goes up to the point where I've made most of what I can make on it, my initial credit on this was 6, what did we get here? Sorry, let me go to my filled orders. My initial credit was 62 cents. If I've made 80% of that, we can buy it back for about 12 cents, we're probably just going to get out of that trade at that point. That would be one reason. That would be one reason we'd exit. Another reason we'd exit, if we're getting close to expiration and we're still kind of in this uncertain range, just get out. Don't let it go all the way to expiration. Even before a couple days before expiration, you're going to want to be out of this. The other thing is, the last reason I would say is this. we have a bullish trade here. My assumption is this is a support level that's going to hold. If the support level doesn't hold and we start to break below that and this bullish trade starts to look bearish, we're probably going to exit that trade at that point anyway. Okay? So there's an example on Disney. Now, what I want to do is I want to give you a different example with a long vertical instead of the short vertical. But if you have any questions on that short vertical, remember, wider spreads typically, worse ROR, better probabilities, break even. Okay? So let's go and let's do maybe a bearish trade here on this. I'm going to let's pull up Dow. Okay, so this is not, don't confuse this with the index. This is not the Dow index. This is Dow, the company. And going back to our technical analysis, what's our trend is down, right? Okay, probably no arguments from anybody here on that. Trend is down. I'm going to look for, let's do a long vertical here on this. Okay, long vertical. Short verticals, typically we're going, well, I want this out of the money. It's going to be a higher probability trade. In this case, we've had a pretty good run. I'm going to assume our run may continue for a little bit longer on this. So let's look at a couple trades here. And when you're figuring out these long verticals, what I want you to think of is, where is this, could this reasonably go to? Not possibly go to, right? It's not a, if we're in the legal system, this is not a beyond a reasonable doubt possibility of it going there. But it's a, where's it reasonable to go to? So I'm going to say maybe down here seems reasonable that it could go down to about 40 here on this. That's where it's, at first glance, it seems reasonable. I mean, if I take this flag pattern, that to that, and I consider the same kind of length, I think we're getting down to about the 40 level there. So that's the first thing. On these long verticals, this is, in this case, we're looking at a long put vertical, but the same thing would be true with the long call vertical. Where can it reasonably go to? That's going to be your lower strike. Okay. And then where do you think it's going to stay? Where do you think it's, it's likely to stay above? Well, I'm going to say maybe in this 44 range or somewhere here where we bounced recently, around that 44 range. So those are the parameters of my trade. Now we actually have to look at strikes and stuff on this to make it work out, but let's see what we got here. So I'm going to go to, let's go to my Analyze tab. We're going to go to Dow. Let me get off vertical here. I'm going to go to single. And I'm going to look out, I may go out a little bit farther. We can go 35 days. Let's just double check our spread widths. There's that 44 strike. That's a pretty wide bid-ask spread. In fact, that is too wide of a bid-ask spread there. You see that? 350 by 320 or 230? 350 by 230, that's a $1.20 difference. Okay? So either I'm going to say niet to Dow, or what I may do is, instead of weekly options, we can look at the monthly options. Here's 42 days out. And we don't have a 44 strike, but we have a 45. I'm going to call that close enough. Now, remember, we were just looking at a $1.20 bid-ask spread here. This is looking a lot better, isn't it? A 10-cent bid-ask spread. So we're going to look to buy this one, and we'll compare the 40 and the 42.50, although my instinct is to go with the 40 because that's where we said reasonably it could go here on this. Or we could do a 42.50 as your long strike. But let's do this. Let me go and do vertical. I'm going to go 45, 42.50. We're going to do a long vertical here. And let me contrast that. And I'm going to do a 45 and let's see, let me make this a $40. Okay, so we have the wider spread possibility and the narrower spread possibility. All right, let's go. Let me get my little drawing tool here. Remember what we're looking at. We're looking at max gain, max loss, return on risk, and our break even. Okay? And let's kind of consider these because they are very different. By making this a $40 instead of the $42.50, the stock doesn't need to go nearly as far to get to our max gain. Okay, we're really most of the way there, but I said that wrong. By going to the 42.50, that's where our max gain is represented. In other words, the lower strike, our short strike is the goal. That's our target. David in the chat says, why such variability in the bid-ask spread? Here's the difference. And you see this very often, by the way. On very liquid, super liquid stocks, there's not that much difference between monthly contracts and weekly contracts. On really illiquid stocks, there may not be that difference. They just are probably going to look terrible either way in terms of bid-ask spread. On these kind of moderate liquidity type stocks, in this case, Dow Chemical would fall in that category, monthly options, which trade longer. In other words, they've been around. When options strikes are, let me actually illustrate this by doing this. Let me get rid of my drawing tool. Okay. When you go out in time, notice we have monthly contracts all out here. And so these are trading. These are accumulating trades, open interest. So they're building up this liquidity. Now, once you get closer to expiration, then you start getting some weekly contracts in there. But they're kind of like running this race, but they're starting at behind. And so you don't get, when you get these weeklies out here, particularly these weeklies that are probably a little bit newer, like this one, you don't have enough time. You just don't have enough time here for the open interest to build up on those weeklies. So as a rule of thumb, weeklies are going to have less open interest than the monthly contracts. Or another way to say it is, weekly options are going to have worse bid-ask spreads than the monthly options. Some it doesn't matter. It really doesn't matter on some. Apple stock probably has enough liquidity regardless of what you look at. But hopefully that answers your question there. Okay, so let's look at this here again. We're looking at max gain. Well, on the wide spread, 45.40, our max gain is going to be the difference between our strikes, $5, minus our 276. So I could probably do that in my head, but I'm going to minimize errors here. 224 max gain. Okay, 224 max gain. Max loss is your initial debit on this, 276. Okay, 276. Return on risk, ROR. Okay, return on risk is going to be 224 divided by 276. I come up with about 81%. 81%. Higher return on risk than what we saw in the short options, but this is a higher probability trade. Okay. Excuse me, I said that wrong. This is a lower probability trade. So therefore, our return on risk is going to be, our return is potentially better. Our break-even point is going to be 45 minus 275. 45 minus, well, 2.76. I'll go with the current price. 42.24. Break even is 42.24. Okay, let's contrast this other one. Max gain is going to be $2.50 minus 1.77 is equal to 73 cents or $73 for the contract's max gain. Max loss is my initial debit, 177. Return on risk, ROR, is going to be 0.73 divided by 1.77 is 41%. 41% return on risk. There's a bigger story than just looking at the return on risk, though, folks. Let's look at this break even. Okay, break even is going to be my 45 minus my debit, which is 1.77, is 43, which is a substantial difference, 43.23. Okay, so let's kind of summarize what we got here. Which one do you want? Which one do you think is better? Certainly, our return on risk is much better by going with the wider spread here on this. But we also are, it's harder to get there. And that's a substantial difference. That's basically a $1 difference in terms of where we're going on this. And it's a tougher climb, so to speak, to get to and achieve our max gain here on this one than it is. In fact, it's substantially. The difference isn't just in the break even. The difference is all, to get my max gain, I got to get down to the $40 level instead of the $42.25 level, or excuse me, the $42.50 level. To me, that's the biggest driver on these trades. So rather than just considering return on risk and break even, I would also throw in, especially on these long verticals, long call verticals or long put verticals, also consider how hard is it to achieve, to hit that target here. And in this case, going down to $40 is going to be significantly harder to get down there. It's a $2.50 difference. So you can look at your probabilities on that if you want. And one way to consider your probabilities is to go here and you can look just at the deltas on your single trades. And so the delta on my 42.50 is about 59, about 60%. In other words, we're there. The stock is already at, the stock's already at the level we need it to be. This is a higher probability trade here on this. If I really think it's going to go down further, certainly there's much more return to be had here, but my delta on that one is about 28%. So it's a much more aggressive type trade. Okay. Now, truth will always prevail brought up a good point. Truth will always prevail said, did you mention doing more contracts with the lower spread? Look, this is going to cost more. So I'm probably going to make them more apples to apples, I may be doing 2 contracts here on this, okay? If I do 2 contracts on this one, then yeah, my commissions are going to be a little bit higher. I would double my debit in terms of the initial debit, which will be a little bit more than this. I double everything, just like remember when you're adding contracts, you're doubling commissions, but everything else is doubling. Return on risk is going to be the same. Okay, break even will be the same. All right, so a lot of this is going to come back down to your good old technical analysis. If I want the higher probability trade, then what I may consider is that 42 around there. That's where the stock needs to be below. If I want the lower probability, but the one that's going to potentially give me a more aggressive trade here, then maybe I do the one with the 40 strike. In this case, just to be different, I'm going to go with the more aggressive trade here. And we're going to put that in our options trades. And we're going to confirm and send that, okay? Maybe we'll do one more example here, folks. Let's look at JPMorgan. There's JPMorgan, JPM. And what's my trend? Trend is up. We're looking more bullish here. Support levels, resistance levels. Well, we have highs here, but that's not really that huge concern to me. We've had highs all along. It only hit up there once, really, in this period. So I'm not going to consider that significant resistance. And our support levels have been getting higher. So I'm going to consider that as a reasonable bullish trade. Let's do another long call vertical here. Where's my target? Where do I think reasonably it can go? Well, I think it can go to 250 or even maybe higher, maybe even over to 255. That may be a little bit of, that's a bigger run, 255, but where's my bounce? Around 245 maybe is maybe my lower end on that. So here's what I'm going to do. I'm going to go to my options trades. Let's check out our liquidity on something we'll go to 35 days out. And let's look and see what we got. And so it's a little bit wider, 50 cents. That's a little bit bigger than I want it to be. So I may go back with those monthly contracts here. Okay, so I'm going to go to those monthly contracts. And we said we're bullish on this. 245, 250 maybe. 245, 250. JPMorgan calls. 245 is here. I'm going to buy this one. Actually, what I'm going to do is I'm going to go to vertical here. 245, 250. I'm going to click on that twice. By clicking on it twice, what I can do is I can run a comparison. I can go 245, 250 or 245, 255 there. Now, one thing you can do is you can go single here, and what we can do is let me go back here and I'm not sure I was looking at let me just look and see what we got here. Oh, you see, these actually aren't. Wait, am I in the same? One sec. I don't need so many strikes. Let me shrink this down. I changed my my strike numbered selector is off. Oh, no, there it is. Okay, there we go. So let's go back to 245, 250, 28 days, about 25 cents. Yeah, so actually this isn't that bad. I think I was looking at very deep out of the money contracts here on that when I was looking at this. These actually are reasonably tight here. 20-cent difference on bid and ask spread on a $3.50 option. That's not terrible. You can also, as James mentioned in the chat, you can also pull up your open interest here, and you can look at your open interest column there on that. Okay, but primarily the easiest way for me to do it is to look at my bid price and my ask price. If you look here at, let's go instead of 28 days, let's go to 35 days. We can compare. Open interest, a little bit more open interest, spreads reasonable. To the prior point that we were talking about earlier, look at your open interest here on the monthly contracts. This goes back to David's question earlier on why the difference in the spreads there between the monthly and the weekly. Well, how's that for open interest for you? there on that. Okay. So, so in any case, there we go. So there's our choices on this. Ultimately, do I think the stock is likely to go to 250, 255? Well, 250 seems like a much easy. That's just going to the prior high on that. And for time's sake, I'm going to do that 255, that 250. Let's confirm and send that and just look at our numbers on this here. Okay, max gain, $260. Max loss, $240. That gives me a return on risk of about 108%, okay? So we stand to gain a little bit more than we risk. The stock doesn't have to move up that much. The stock right now is at 246. It just needs to go to 250, which, you know, you go $3, $4. Well, on a $250 stock, that's not that much. I'm just going to do one contract here on that, okay? Our break-even point, 247.40. We need this to move up about $1. And that's where the technical analysis comes in. You wouldn't do the trade unless technically you had a reason to do it, unless you were bullish on that. So what I'm going to do is I'm going to send that ladder trade there. That is a long, and it's thinking right now, that is a long call vertical there. So let's just summarize what we did today. We talked about, first we talked about short verticals, and this would apply to short put verticals or short call verticals. Generally, the wider the spread, the better your, the wider the spread, the worse your return on risk. It may be not a big difference, which we encountered in our example trade, or it may be a much more significant difference there. And so that may be your judgment there on whether you want to do that but even with the better return on risk, with the narrower spread, your break even, your probabilities are going to be a little bit less there. So those are the main factors on short verticals. On long verticals, consider where your target is. By adjusting that price, assuming the long price is the same, by adjusting that short strike, you're changing your target level. How realistic is for that stock to achieve that target level is going to be the main consideration there, everybody. Okay, so those are kind of the takeaways I want you to go away with on this. We just used verticals today, but hopefully as we do this, you become more adept with using the Thinkorswim platform to try and view your trades. Remember, the main items: max gain, max loss, which gives you your return on risk, and then your break even, which gives you your probabilities. Those are the considerations you need. Make sure you subscribe to the Trader Talks channel on Schwab and on YouTube. So on the YouTube Schwab channel, Trader Talks, make sure you subscribe to that. James, thank you for joining me and helping me out in the chat with those answers. Always appreciate you on that. And I want to thank each of you for joining me. Coming up next, we have ThinkScript Studies. Wish you all a wonderful weekend ahead, and we'll see you same time next week. Bye-bye, everybody.